If you desire to protect your capital and take advantage of the market volatility in precious metals markets, we're going to be sharing with you a way that you can make more money with a proven trading strategy. Did you take advantage of the most recent market volatility? Did you lose money? The reason why people are losing money is because they don't have a winning strategy to trade these markets. On February 12, 2026, gold was off by $150 an ounce, and platinum was off by about $100. In the first quarter, we've seen businesses make more money than they have in the last 2 years, and others have lost money trading the market. Rich, we have some trading rules that we like to use in our business, and I'm fully aware that companies use more sophisticated strategies than what we're going to talk about today. Many of them involve maybe a hedge book with a processor or a smelter refiner. Others in the industry might use a hedge account with a trading house. But we're not talking about that type of a strategy today. We're talking about something a little bit different that we use here. What can you say? What do you see that we start with?
Volatility is your friend.
Volatility is your friend. Why?
Well, because with volatility, that brings opportunities in the marketplace, correct?
Yeah, well, the market goes up, the market comes down, right?
Mm-hmm.
And so if you have a risk appetite to expose your position to the volatility, then you have an opportunity to take advantage of a rise or a fall in the market to your advantage.
That's right.
So what's it do? It creates opportunities so that you could buy assets at a discount. That's one of the main reasons, right?
Definitely.
And also, well, it goes up, right?
Always.
And so what are we doing when it goes up? We are selling into strength. So we're buying the dips, right?
Yeah.
Because of volatility, and that's an investment strategy. So after the price dropped recently, how do you leverage that? Well, you try to get back into the market at a lower price, and that's what we're talking about here. But how do you put that into practice? Isn't that really what we want to be discussing?
Yeah, definitely. Maybe we can just kind of pull back the curtain just a little bit and just share some of our trading, what we do, like you said, here on a daily basis.
So we have basically 3 rules, right? We talk about volatility is your friend.
Right.
We talk about buying into weakness, because that creates opportunity.
Right. Buy the dip.
And then we also talk about selling into strength. So those are the 3 basic rules that we like to use. But with risk can come reward.
Well, that's the old saying.
Or not.
Right. No risk, no reward. Or there can be risk and you can lose because of market conditions.
So understanding there's a certain amount of risk involved with trading, how do you mitigate that risk? Well, I'm asking myself this question. How do you mitigate the risk, right?
Yeah.
It depends on your allocation of your capital. You have a certain amount of capital in your business. Now, I don't know what kind of business somebody has in the precious metal space. There's so many different types of businesses out there that buy and sell precious metal. It could be gold, silver, platinum, palladium, rhodium, whatever it is.
Right.
Some of them are large operations. Some of them are mom and pop operations. And so how does a business owner protect themselves? And also, how do they expose themselves to a certain amount of risk to take advantage of some extra profits that could be available outside of the buy-sell spread? Well, it's about your allocation of your capital.
Yeah.
Right?
Definitely. A third, and third.
Yeah, that's kind of what
our
we do,
mentality, right?
We look at it as a third, a third, a third. So what does that mean? Well, that means a third of it is cash. We like to say, keep your powder dry. So that's what you use to buy your inventory with, right?
Definitely.
So you're on your balancing of your risk allocation, or our balancing of our risk allocation, because we're sharing that with people. We like to keep a third of it in cash. But then we also have 2/3 that's in precious metal inventory that we've purchased, that we've acquired. Now, this inventory is exposed to the market up and down every day.
That's right.
Shoot, we had a $150 down day in gold recently. That's a big number. $100 an ounce on platinum. That's a big number.
Yeah.
How do we mitigate some of that risk? Well, if half of our ounces are hedged, committed, sold, maybe not delivered, maybe not paid for yet, but they're hedged, they're covered, then the other half is exposed to the market.
Well, that goes to your no risk, no reward, right?
Yeah, it
The
does.
unexposed, the exposed, meaning that it's not hedged. The price isn't locked.
Right.
It's not sitting in the metals pool account waiting for us to decide what price we'd like to sell it at. Hey guys, have you ever wondered if you're leaving money on the table when selling your scrap catalytic converters? Well, we have a solution for you. We have a converter price guide with thousands of part numbers. Just use it, check it out. You can sign up today, have access for it today. See if you are leaving any money on the table, or keep the guy honest that you're selling to. You want to check it out, make sure you're making the most profits for your business in today's market. It's super simple, just click the link below, get started today. Now let's get back to the video. Speak a little bit to that, the exposed 1/3 of the materials.
So, well, you have a cost that went into it. That 1/3 of your risk allocation is exposed to market volatility. And this is where our rules of trading that we use come into play, because volatility is your friend, right? Volatility is your friend.
Yeah.
Why? Because if it spikes up, you can catch a hedge.
Yeah, lock
You can make
that
a sale.
price,
You can
right?
lock that sale at a higher price on that unhedged material. However, the opposite is true. The market could fall. $100 an ounce on platinum. All right. Well, probably not selling today.
Yeah, I would advise not to sell today.
But you have your capital still. Your powder's dry. You're hoping to be able to buy in that environment on a day that you're not necessarily selling,
Right.
because you have capital available. And that other 1/3 that's already hedged, it doesn't affect it. It doesn't matter.
No, it's locked.
It's just a matter of the timing on when to pull the capital,
Right.
when to complete the sale, because it's hedged. So it could go up, it could go down. And so if my 1/3 of unhedged metals are down in value today, now we're upside down in the position, we're losing money if we were to sell it today. Well, maybe you don't have to sell it today, but you have an opportunity to buy something else on a down market, and you have 1/3 of your capital available.
That's right.
Pull the trigger.
Yeah, pull the trigger.
Buy that,
Right.
right?
Because you know there's going to be a rebound eventually.
Well, it may not. You may decide, I need to hedge this
Well, that
because the
that would
market's
be
looking
wise.
extremely weak.
Right.
So I bought on a down day and I hedged on that down day to lock in my profits. So this trading is kind of a tricky thing. You have to have some intuition. You have to have an understanding of what's taking place in the market and what's driving the prices up or down. Is it a trend?
Yeah.
What do they say in trading? Your first loss is your best loss.
Yeah.
Because if you close out a position, you lose X amount of dollars on it today. And if you would have held that for tomorrow or into next week, it could really get bad. It could be devastating.
Yeah.
So there's some trading rules that apply. You know, your first loss is your best loss. Sometimes if you need to close out a position, don't hesitate to take that small loss, because tomorrow could be quite significant. And just to recap some of that, right? We have those 3 trading rules that we apply, right? We have our volatility is your friend, sell into strength, buy in weakness,
Yeah, buy
And
it by
then
the dip.
asset or risk allocation of your assets, your capital. We like to keep a portion of our powder dry, our capital dry, take advantage of buying, keep half of our metal ounces hedged, the other half exposed to the market. We might hedge it, close it, and have it all hedged because we feel the market's continuing to fall.
Well, what's it been doing since late January?
It's come down.
It's come down.
It's come down quite a bit.
Right.
But it's still up from where it was in October.
Yeah.
So the market is up. The volatility is, if you can manage the risk and you have a tolerance for that risk, you have opportunity to take advantage. I remember looking at a couple of positions where we were majorly upside down, and we decided not to sell into that market, and we held it for about 10 days, and it turned into a significant profit.
Yeah.
So you have to be able to walk away and sleep at night too.
Yeah.
And the way I do it is I don't have all of it exposed in the marketplace, just a piece.
Right. That's avoiding the panic sell, right? You got to have discernment. You got to have discipline. But it also helps that you've been in the precious metals market 40 plus years. So you've seen this, right?
Right.
I mean, statistically, what does the market do? It's kind of like a snake, up and down, up and down.
Oh, yeah,
right?
that's right.
You know?
We use that analogy. Thanks, Jacob. Palladium is a snake. You want to call
that's
that
our
one
friend,
out again?
Jacob.
Yeah, it does this. The market does this. Palladium does that.
Right.
Yeah. So the ups and the downs, you can take advantage of that volatility. You can increase your profits a little bit. It's best to not overexpose your position to the market volatility. We like to take a little bit of volatility to increase the revenue, and it works most of the time. Not all the time, but it works most of the time.
Yeah, we try our best, right?
Yeah, everybody does.
Everybody does.
Yeah, and no one has a crystal ball. We don't know exactly what it's going to do tomorrow. So try to determine your risk tolerance. Try to determine how much capital you need to reserve, and whether you have any tolerance for exposure to market volatility or not. And watch it closely on a day-to-day basis. Run your spreadsheets. Look at your profits. Look at your losses. Do your rebalancing. And come up with a conviction, make a decision, and follow through. That's what I would have to say.
Well, that's great advice. So let's continue this going into 2026.
And make more money.
Let's make some more money. Hopefully everybody watching, they'll make more money, more profits for their businesses.
Yeah, that's right.